Japan looks like a failing country on the surface. Wages are stagnant. Households are poorer. Young people can't save. Middle-aged workers are disposable. And yet, Japan's stock market refuses to die. In fact, it's thriving. This is not a contradiction. This is the business model. Japan has quietly become one of the most shareholder-friendly markets on Earth, not because it treats its people well, but because it doesn't. Let's be blunt. Japanese companies are posting world-class EPS growth, improving PER efficiency, and historically low PBR distortions. Global investors look at Japan and see discipline, stability, and reform. What they're really seeing is this: labor costs suppressed for decades, no real wage growth pressure, weak unions, a population too old, too tired, and too insecure to fight back. This is not innovation-driven growth. This is extraction-driven growth. Japanese workers are not stakeholders. They are cost control mechanisms. Companies squeeze labor harder every year, freeze wages, cut bonuses, and quietly normalize irregular employment. The savings don't go to workers. They don't go to consumers. They go straight into internal reserves. Japan's corporate internal cash holdings are now at record highs. Trillions of yen sitting idle, not reinvested into society, but used to. Inflate balance sheets, stabilize dividends, buy back shares, please foreign shareholders. So when global funds look at Japan, they don't see a declining society. They see low risk, high discipline, obedient labor, and predictable returns. That's why Japanese stocks go up while Japanese lives go down. And this is only the beginning. Because the poorer Japan becomes, the easier it is to squeeze more out of it. Japan's market metrics look perfect, but these numbers aren't from growth, they're from suppression. Profits were optimized by removing labor from the equation. Rising EPS isn't from innovation, it's from suppressing wages and cutting costs. With labor income capped, corporate margins expand automatically. A low PER is attractive because there's no social unrest, no mass strikes, no wage revolts. To investors, Japan isn't undervalued, it's undercontested. And low PBR was fixed with share buybacks and hoarding cash, not raising wages. The core truth: Japan is a labor extraction system. Its stock market is strong because its people are weak, labor is cheap, and resistance is minimal. To foreign capital, Japan isn't a declining economy. It's a perfectly controlled extraction environment, a safe exploitation state. Profits are protected because people are trained to endure losses quietly. This cultural suppression of resistance means no sudden wage explosions or unpredictable labor movements. For investors, this is pain without noise. The weak yen is a deliberate feature, boosting exporters and making Japanese assets cheap for foreign buyers. And corporate governance reform focuses on shareholder returns, not worker welfare. As long as this structure holds, Japan remains a reliable and even admirable investment. Why Japan is hell for workers but a long-term paradise for investors. Here is the part nobody wants to say out loud. Japan's stock market strength is not temporary, it is structural, and structures don't care about feelings. Why this system doesn't collapse. Easily, people keep waiting for Japan to snap. A labor uprising, a political reset, a wage revolution. That fantasy misunderstands Japan entirely. Japan doesn't explode, it shrinks quietly. When conditions worsen, workers don't strike. They downsize their lives, they stop marrying, they stop having children, they stop consuming. From a social perspective, this is catastrophic. From a corporate perspective, it's efficient. Lower consumption pressure means no demand-driven inflation, no urgent wage hikes, no labor bargaining power. Companies can plan long-term knowing labor will adjust downward automatically. That's stability, the illusion of cheap Japan. Foreign media loves saying, Japan is cheap. Undervalued market. Turnaround story. Wrong framing. Japan is not cheap. It is compressed. Households are compressed. Expectations are compressed. Wages are compressed. Lifestyles are compressed. But corporations are not. Corporate profits are insulated from society. They live in a separate ecosystem. Global revenue, weak yen, leverage, domestic cost suppression. This decoupling is the key. The worse life gets locally, the cleaner earnings look globally. Why long-term investors love this setup. Long-term investors want three things: predictability, margin protection, policy non-interference. Japan offers all three: predictable labor behavior, predictable political cowardice, predictable prioritization of corporations. This is why Japan isn't traded like Italy, or France, or the US. Those countries fight back, Japan doesn't. So when funds allocate capital, Japan becomes a defensive allocation, a volatility hedge, a quiet compounder. The returns aren't explosive, they are dependable, built on endurance, not prosperity. The uncomfortable conclusion for individuals. Here's the part people hate most. If you live in Japan and you rely on wages, this system will eat you alive. But if you understand the system, you don't fight it. You position yourself. You don't bet on income. You bet on ownership. You don't wait for reform, you front-run extraction. Because Japan will not suddenly become fair, it will become more efficient at extracting value upward. So shut up and buy Japanese stocks. This is not moral, it's mechanical. Let's end the hypocrisy. Japan's stock market is strong because Japan is weak, not despite it, because of it. This is not a temporary distortion. This is not a cycle. This is not a recovery phase. This is the final form of a mature extraction economy. Why the logic is brutally simple. When a society loses bargaining power, capital gains control. Japan has no wage pressure, no labor rebellion, no political courage, no demographic future to protect what it does have. Record corporate internal reserves. Rising EPS without innovation, PERs that look cheap but are structurally protected, PBRs that improve through buybacks, not shared prosperity. This is not a broken system. This system is working exactly as designed. Who loses and who wins? Let's stop pretending everyone participates equally. Losers, wage earners, young workers, households, anyone waiting for fairness. Winners, listed corporations, shareholders, foreign capital, anyone who owns instead of works. The Japanese worker is no longer the engine of growth. They are the buffer. They absorb inflation. They absorb currency weakness. They absorb policy failure, so earnings don't have to. Why this trend intensifies, not reverses. As Japan gets poorer, consumption weakens, wage demands disappear, social expectations collapse, and that makes earnings cleaner, not messier. Margins stabilize, forecasts become easier, risk premiums shrink. From a market perspective, Japan becomes more attractive, not less. This is why betting against Japanese equities on moral grounds is naive. Markets don't price morality, they price obedience and predictability. Japan offers both in excess supply. The final answer. No one likes. If you are waiting for Japan to fix itself before investing, you will miss the entire move. If you are waiting for wages to rise before stocks rise, you do not understand extraction economies. Japan is not a country you believe in, it is a machine you exploit. So yes, Japan gets poorer, Japanese lives get smaller, Japanese stocks go higher. That is the trade. You don't have to like it. You just have to decide whether you participate. Because Japan's market isn't asking for your approval. It's already priced in your silence.